Picture this, a bunch of guys in suits sitting around a table in Frankfurt, controlling the money supply for nearly 400 million Europeans. Sounds like a conspiracy theory, right? Well, welcome to the European Central Bank, where monetary policy meets continental ambition, and where the phrase, "Trust us, we're bankers," somehow became the foundation of modern Europe. Today we're diving into the blueprint that shapes your morning espresso price in Rome and your mortgage rate in Amsterdam. We're talking about the European Central Banking System, how it started, where it came from, and why understanding it might just save you from financial illiteracy in a world run by spreadsheets and economic theories. Let me paint you a picture. It's the 1990s. The Berlin Wall has fallen, the Soviet Union is history, and Europe is having its biggest identity crisis since Napoleon tried to redecorate the continent. European leaders are sitting around thinking, you know what would be really fun? Let's create a single currency and hand over our monetary sovereignty to a group of technocrats we'll strategically place in Germany. Because nothing says learning from history like centralizing financial power in Frankfurt. But here's where it gets interesting. The European Central Banking System didn't just appear overnight like some monetary magic trick. This thing has roots that stretch back to the economic chaos of the 1970s, when European currencies were bouncing around like ping-pong balls at a championship tournament. The story really begins with something called the European Monetary System, established in 1979. Picture this as the awkward teenage phase of European monetary cooperation. European countries were tired of their currencies doing the economic equivalent of a drunken dance every time the dollar sneezed or oil prices hiccuped. They wanted stability, predictability, and the ability to trade with each other without needing a calculator to figure out exchange rates every 5 minutes. The European monetary system created something called the exchange rate mechanism. Think of it as training wheels for a continental bicycle ride toward monetary union. Countries agreed to keep their currencies within certain ranges relative to each other. It was like a gentleman's agreement, except instead of agreeing not to steal each other's golf balls, they agreed not to devalue their way out of economic problems. But here's the thing about gentlemen's agreements. They work great until someone decides to stop being a gentleman. Enter the early 1990s and what economists politely call currency crises, but what really should be called the moment when markets decided to test whether European politicians actually meant what they said about monetary cooperation. The British pound got absolutely demolished in 1992. George Soros, playing the role of financial villain with remarkable success, essentially bet against the Bank of England and won big. The Italians saw their lira get pummeled. It was like watching a really expensive game of economic Jenga where removing the wrong piece could collapse entire national economies. European leaders looked at this chaos and had what we might generously call a moment of clarity. They realized that half measures in monetary policy are like being half pregnant. It's a temporary state that's going to resolve itself one way or another, and probably not the way you'd prefer. Enter the Maastricht Treaty in 1992. This wasn't just any treaty. This was the document that essentially said, we're going to create a European central bank, issue a common currency, and see if we can make this whole monetary union thing work without accidentally destroying our economies in the process. The optimism was touching, really. The treaty laid out the blueprint for what would become the European Central Banking System. They established convergence criteria, basically a checklist that countries had to complete before joining the monetary union. Think of it as the economic equivalent of a driver's test, except instead of parallel parking, countries had to prove they could manage their debt, control inflation, and maintain stable exchange rates. The criteria were specific and demanding. Countries needed to keep their budget deficits below 3% of GDP, maintain public debt below 60% of GDP, demonstrate price stability, show stable exchange rates, and keep long-term interest rates within reasonable bounds. It was like a financial fitness test, and many countries discovered they needed to do some serious economic cardio before they could qualify. Now here's where the geography lesson becomes crucial. The European Central Bank didn't end up in Frankfurt by accident. Location matters in central banking almost as much as it does in real estate. Frankfurt was already home to the German Bundesbank, which had built a reputation as the most credible inflation-fighting institution in Europe. The Germans had turned monetary conservatism into an art form, treating price stability like a sacred religious doctrine. Putting the European Central Bank in Frankfurt was essentially Europe's way of saying, we want the German approach to monetary policy, but for everyone. It was borrowing credibility through geographic association, like moving your startup next to Silicon Valley companies, and hoping some of that innovative spirit would osmose through the office walls. The European Central Banking System officially launched in 1998, with the European Central Bank opening its doors in Frankfurt. The system consisted of the European Central Bank itself, plus all the national central banks of European Union member states. Think of it as a federal structure, where the European Central Bank sets overall policy, while national banks handle implementation and maintain connections to their domestic banking systems. The euro launched as an accounting currency in 1999, and physical euro banknotes and coins appeared in 2002. Watching 11 countries simultaneously abandon their national currencies was like watching a massive logistical magic trick. One day you're paying for dinner with Deutsche Marks, the next day you're using euros, and somehow the entire payment system doesn't collapse into chaos. The European Central Bank's mandate was refreshingly simple compared to other central banks. While the Federal Reserve in the United States has a dual mandate of price stability and full employment, the European Central Bank has one primary objective: maintaining price stability across the Eurozone. It's monetary policy with laser focus, assuming you believe that keeping inflation around 2% annually is the key to economic prosperity. But here's where the philosophy meets the ledger in interesting ways. The European Central Banking System represents a fascinating experiment in monetary sovereignty. These countries essentially agreed to give up one of the most fundamental aspects of national control, the ability to print money and set interest rates, in exchange for the benefits of monetary stability and reduced transaction costs. From a purely logical standpoint, it makes sense. Why have 19 different currencies when you can have one? Why deal with exchange rate volatility when you can eliminate it entirely? Why maintain separate central banks when you can achieve economies of scale through consolidation? But from a practical governance perspective, it creates some interesting tensions. When the European Central Bank raises interest rates to combat inflation in Germany, those same interest rates apply to countries like Greece or Ireland, regardless of their specific economic conditions. It's like having one thermostat control the temperature in 19 different houses, each with different insulation, different numbers of residents, and different preferences for comfort. The 2008 financial crisis and subsequent European debt crisis really tested this system. Suddenly, the benefits of monetary union came with some significant costs. Countries that might have devalued their currencies to regain competitiveness found themselves locked into fixed exchange rates. Nations that might have pursued more aggressive monetary stimulus discovered their monetary policy was being set by committee in Frankfurt. The European Central Bank had to evolve rapidly, moving from its original conservative mandate to implementing quantitative easing programs that would horrify the German central bankers who inspired its creation. Sometimes reality has a way of forcing even the most carefully designed systems to adapt or risk irrelevance. Today, the European Central Banking System oversees monetary policy for over 300 million people across 19 countries. It manages one of the world's major reserve currencies, influences global financial markets, and continues to navigate the tension between maintaining price stability and supporting economic growth across diverse national economies. The lesson here isn't just about central banking. It's about the blueprints that shape our economic reality. Understanding how the European Central Banking System emerged from currency chaos, political ambition, and geographic pragmatism gives you insight into how financial power actually works in our interconnected world. Whether you're trying to understand why your mortgage rate changed, or wondering why certain economic policies get implemented across multiple countries simultaneously, the European Central Banking System provides a fascinating case study in how institutional design shapes everyday economic life. Facts, logic, and the ledger, that's how we decode the systems that run our world. Don't forget to like this video if you enjoyed our journey through European monetary history, and subscribe for more deep dives into the blueprints shaping tomorrow's world.